Today's podcast is brought to you by Delupa. Delupa's database of over 2,500 models contains the most KPIs for each company, along with non-GAAP adjustments and guidance specific to the business and the quarter. Clients use Delupa's existing data to construct their own models faster and ramp up on new names more readily. Coupled with Delupa's plugin, which automatically updates numbers and formatting within your model, you'll never need to input numbers manually again. All of Delupa's data points are contextual, audible, and accurate. Their AI algorithms allow them to collect the most data on their companies at the greatest speed and build out their model database at a rapid pace, while their final layer of human analysts ensures total accuracy of their models. You can even update KPIs for multiple different companies in an industry model that allows you a bird's eye view for better idea generation. Save time with Delupa to do more value-added work. No more data errors, no more Excel monkeying, just the fundamentals, all at your fingertips. All right, hello and welcome to yet another Value Podcast. I'm your host, Andrew Walker. For those of you listening on the YouTube, my dog Penny's back here making her first appearance. If you like this podcast, it'd mean a lot if you could rate, subscribe, review it wherever you're listening to. But today I'm happy to have on for the second time my friend Conor Maguire. Conor is the founder of the valuesits Substack. Conor, how's it going?
Good, Andrew. Yeah, good to be back on. Thanks for having me.
Great. Hey, thanks for coming on for the second time. Let me start this podcast the way I do every podcast. First, a disclaimer to remind everyone, nothing on this podcast is investing advice. Please do your own work, do your own research. We're actually going to talk about, it's a pretty good sized company today, but it's a little on the illiquid side. The family controls about 60% of it. Tweedy Brown's got another 8%. So the float's on the smaller end. So everybody should just keep all those in mind, maybe a little extra risk here, but please keep that in mind. Second, a pitch for you, my guest. People can go listen to the first podcast for the original pitch if they want a full one, but I don't know any better pitch than say you turned your podcast to a paid Substack about a month ago, and who was subscriber number 1 2 minutes after you switched over to paid Substack.
Yeah, you were straight in there, Andrew. Yeah, you were number 1. All right. So no, thanks for your support on that.
No, look, I woke up and opened my email, and the first email in my inbox was you announcing it like 3 seconds after I opened my email, and I was just boom, instant. But look, I love your work, and that's why I was subscriber number 1, and that's why I'm happy to have you back on the podcast. So all that out the way, let's turn to the company we're going to talk about today. You had a very clever name for them. The company is Soul Group. The name of your post was Deep Breath, Deep Value, which I thought was really good. But I'll turn it over to you. What is Soul Group? Why is the title Deep Breath, Deep Value, all that type?
Yeah, so thanks, Andrew. So Sol Group is an Italian-listed industrial medical gas business. So it's listed on the Italian Stock Exchange. And as you said, it's 60% controlled by the two controlling families. And the current management team are the third generation of the two families to lead the company. So, I mean, Sol Group basically provides or it produces industrial medical gases. So principally oxygen, nitrogen, hydrogen, carbon dioxide, helium, and then some other niche specialty gases, and it provides them across the various industrial sectors and into the medical sector. So if you think about any kind of modern industrial and manufacturing process, usually requires at some part of the production process oxygen, nitrogen, hydrogen, and so on. So these are really essential gases or commodity inputs into industrial processes. And so that's one side of the business. That's approximately about 50%. And then the other 50% is really on the healthcare side. So again, they provide gases like oxygen, hydrogen, carbon dioxide to hospitals, home care facilities, and also kind of home home respiratory services. For example, ventilators for people who are at home, not in a hospital setting, but that require regular specialty kind of medical care.
Perfect. So there's a lot of stuff to dive in there. A lot of comps, a lot of other things we can talk about. But I guess I want to start with the question I start with and everything. There are a lot of investment opportunities out there. Like, this is a reasonably large company. People have known for years. We'll probably talk about private equity's interest stuff, but people have known for years that medical gases and these types of things, industrial gases, are a pretty good business. So my first question is just, what are you seeing that the market's missing that makes, I mean, in your write-up, you say, hey, in a base case without a takeout, this can basically, it's done 20% annualized for the past, I think it was 20 years. And you think can do it 20% annualized for the next 20 years. So what are you seeing that kind of the market is missing in this company?
Yeah, so I mean, I think this, I mean, what makes this stock interesting to me is that it has kind of three different attributes all in one. So firstly, I'd say this is kind of like a kind of a Buffett type stock in that it's a very, very stable, very well run, reasonably good return on capital business with very predictable earnings. So this is what I'd call it kind of a structural winner in that, for reasons that we could get into in terms of the particular business model and the industry setup. This, I mean, if you look at a chart, this business has consistently grown earnings and EBITDA over the last 20 years, and its EBITDA margin is kind of a rock solid 23% throughout that time. So it's a very stable, very predictable business. Number two, that's the first reason. So the second reason why it's interesting is that it is clearly undervalued. So this business trades at about 7 times EBITDA, and its larger peers such as Air Liquide and Lind Group trade at about 12 to 14 times. Similar private market assets have traded at 12, 13 times EBITDA as well. So relative to the comps, this is very, very, very cheap at 7 times EBITDA. And there's particular reasons why that might be, but I think again it's mispriced even considering those reasons. And then I suppose thirdly, this is kind of a special situation as I see it in that it has no sell side coverage. It's completely overlooked by the market. So that's probably one of the main reasons why it's cheap. No one really knows about it. And number two, and this is kind of what I think makes it really interesting, is that this is a family run and operated business for generations. The current senior management team, from my understanding and from my own research, are likely to retire within the next 5 years. There's no one else in the family to take on the management role or the CEO role. And the likelihood is that they will probably cash out to private equity within the next 5 years. There isn't really anyone within the family, as I understand it, that would take over management. And so they've received numerous approaches by European private equity houses over the last number of years, and haven't sold as yet. But I think just given the multiple arbitrage, the age of the senior management team, and with no successors, it's an obvious take private candidate, and the current market cap $1.5 billion. This is easily worth double that. In a cash out scenario.
I want to dive into a few things in what you just said, and then we'll probably go a little deeper into the business into the back half of the podcast. But the first thing you said, this is a Buffett-like business. It's funny you said that, because when you said it, I started remembering. I was like, hey, so there used to be Airgas and I believe Praxar were two big U.S. not competitors, because this tends to be a local business, but they were the two biggest, Airgas. And I was like, wasn't Airgas a Buffett play? And it wasn't a Buffett play, but if you go and you look, Bill Ackman in 2013, he made his biggest bet ever on air products. He said, it's the biggest investment I've ever made, $2.2 billion. And he called it a Warren Buffett business. And obviously Ackman follows like a Warren Buffett-like style. So these are businesses I don't think Buffett's invested in before, but these are Buffett-like businesses. Exactly what you said. Stable products, good returns on capital, advantage, all that type of stuff. And then let's dive into the second thing. So I do think a big part of the thesis here, and again, we'll go into the business itself in a second, but a big part of your thesis is, hey, this is a almost 100-year-old business. The founding family, they control it, they own it, they own 60% of it. They've got the management team in here. They're getting up there in age. They're going to turn 70 in the next few years. And when they do, you say, hey, a private equity style takeout is likely. So I want to dive into that a second. I know private equity firms have tried to take these guys out before. Why don't you discuss that history? And then I might push back a little bit on the private equity side.
Yeah, so I mean, as you said, Bill Ackman was well known in kind of his previous interest in the sector, and there's been a lot of consolidation. So two major deals that have happened in the space in the last kind of 5-10 years have been, firstly, Air Liquide's acquisition of Airgas in 2015, which created the global #1 player, and then following that, a couple of years later, Lind Group, the German business, acquired Praxair, and that created then the #1 market leader. So with those two acquisitions, that really consolidated the top end of the market. And so there's only really, with Air Products now in the US, the only remaining kind of the big three. Outside of that, there's one or two players in Japan. And then you've got some smaller regional players, of which Sol is one of the bigger ones, Sol. And then there's another privately held German business as well, very similar, slightly larger in revenues, but pretty similar. So, you know, the industry has consolidated significantly in the last number of years. And, you know, when you look at kind of the earning, the consistency of earnings, the business model in terms of very stable cash flows, contracted long-term customer contracts, this lends itself really well to kind of, you know, leveraged buyout transactions, and you know, the cash generation is very strong as well. Another point I think is particularly relevant at the current time is that all these contracts are inflation linked. So, you know, they pass on, you know, electricity and energy are the biggest input costs in these businesses, and because of the essential nature of these gases that are sold to industrial medical customers, they're able to pass through those cost increases. There's a slight 1 or 2 quarter lag, but generally they pass the cost increases on. So I mean, when you look at that type of setup in the current market, I think you know, this is the type of business that private equity would be very attracted to, especially when you look at the discounted valuation.
Yep. And your article mentions that private equity has approached Sol before. Can you go into the background of private equity's history with Sol?
Yeah, so these weren't public, you know, at the time publicly reported thing, but you know, from talking to management and analysts who cover the industry, it's kind of it's known anecdotally that private equity have approached the business in the past. So so you know, in terms of actual deal terms, they were never publicly disclosed. Gotcha. I know there's been ongoing conversation, and this has been on the radar of a number of private equity houses in Europe for a number of years.
And when you talk to management and they say, hey, we've been approached before, but we've rebutted them, why did they say they rebutted private equity firms in the past?
Simply because they did. I mean, 5 years ago, or in the last 5 years, they haven't really been ready to sell. They're content to hold on to it for now. But as they have tried to kind of figure out succession plans, but you know, that window of time to kind of, you know, for the succession plan to be implemented is kind of narrowing now. And you know, the likelihood is that there won't be a family member, and rather than kind of appoint someone from outside the families to take on leadership roles, you know, they would rather just cash out and sell. Yeah.
So, and that's based on your talks with them, is kind of what you're thinking?
Yeah, I mean, I've spoken to management. I've also spoken to people in the industry as well, and who have kind of corroborated kind of that is their sense as well, and from separate conversations they've had.
No, it makes total sense, because I guess the pushback I would have on the private equity idea is this is a 100-year-old company, and yes, the family owns 60%, and there's going to be discussion issues. But if I was the family, I'd be like, cool, I own 60%. Like, why am I going to go sell this to a private equity firm when I've got this business? I control it. That gives me some influence. Like, I've seen it 100 times. You know, just keep your 60%, throw it into trust for the whole family, and just be your own private equity firm, right? Like, just go hire an outside manager, keep 60% control, and keep this kind of keep this public, but keep it kind of a controlled family public thing. You get I don't know, there's plenty of US companies, none are like jumping right off the top of my head, but there are plenty of US companies that have pulled this, right? Mars Family. I don't think Mars Family actively operates the business anymore. But if you look at the richest people in the world, like 20 of them are from the Mars family, because they own M&M, they own Mars, and you know, it's just a professional, like, kind of private business at this point.
Yeah, well, I think one other factor in this is that the public markets clearly are never going to value this business at what it's really worth. You know, and as I said, the multiple arbitrage between this and some of its larger peers and some of the private market deals that have been done in the space is just so wide that, you know, I think that's a sufficient incentive for them to kind of maybe think, okay, you know, there's no one else in the family to take this on. There's a big potential, you know, liquidity event for the family, and it's actually 2 families involved. So, you know, I think the kind of the agreement there is, or the understanding is there, that if they can't keep it within the family, you know, a liquidity event and a cash out is the next best thing.
Would there be any politics involved with that? Because I've seen family-controlled Italian companies before that have tried to sell, and I say Italian, but probably European, and heck, at this point, probably all across the world, but family-controlled companies that have tried to sell to private equity. But I think it's particularly in Europe where the European regulators say, oh, we don't like this, right? Like the private equity, scary, going to put leverage on the balance sheet, might try to close down some underperforming plants, might try to fire some employees. And like, I have seen European companies block family controlled, not fully block, but they can make life really hard for making that type of control. So do you think there'd be any issues? Because an industrial gas business employs a lot of people. It buys a lot of power, not just directly, it employs a lot of people indirectly too, right? It's almost critical infrastructure because it's powering hospitals. So do you think there could be some political pushback on that?
In this case, I don't think so because of the relative size. I mean, if you were looking at a much larger player like, an Air Liquide or someone like that, or someone of that approaching that type of scale, yes, I think the implications of a private equity buyout would be more significant. But in this case, I mean, this is a 1 billion revenue business. In the overall, it's an important business in the markets that it operates in. But in the overall scheme of things, I don't think a private equity acquisition of it would be material enough to prompt regulatory or political concerns.
Okay. You mentioned multiple arbitrage a few times, right? This trades for about 7 times EBITDA on the capital markets currently, which look, 7 times EBITDA, even after a pretty decent market sell-off recently, I would say that's the price of a below average business probably gets. I'd say a normal business probably is 8 to 9 these days. A good business is 10 to 12 plus. And that's just very general, right? Very general, but that would just be rule of thumbs and adjust for all sorts of other stuff. But you've mentioned multiple arbitrage a few times. This trades for 7 times EBITDA. What does a normal air products company trade for? What do they tend to trade for in a takeout? Doesn't matter if the takeout's private equity versus strategic, all that type of stuff.
Historically, kind of 12 to 14 times for comparable businesses. So, the most direct comp is when I think it was when it was the Praxair acquisition happened back in 2018. I think it was they had to sell their European assets to a Japanese company, Nippon Sanso, and that was their European assets with about 400 million EBITDA. Sol has about a 260 million EBITDA, so ballpark kind of scale. And that traded for 12.5 times or 13 times to Nippon Sanso. So that's really the benchmark, and that's actually a benchmark valuation. When I asked management what did they think the business would be worth or should be worth at a fair consideration, that's the type of multiple that this type of business would merit.
Yep. So almost. I mean, again, trades for 7. You just listed a comp at 13. We'll round up and say the multiple would almost be double what it currently trades for. And there is a little bit of leverage here. We'll probably talk about leverage and everything in a second. But so you're talking more than a double on the shares if we woke up tomorrow and they were sold for the multiple that you thought they should go for.
Correct. Yeah, exactly.
Perfect. Okay, so let me go to my second favorite question, right? This is a family that owns 60%. They know the business really well. They've communicated to you, and I think they've communicated across the board, hey, this is a good business that deserves to trade for a multiple much higher than we're currently trading for. We can talk more about leverage in a second, but this is a under-levered company, I would say. It's a little bit over 1 times leverage, if I'm doing that math in my head correctly. Businesses like this can generally support a lot more leverage than that, right? Very consistent, economically resilient business. You can support a lot more leverage. So my first question would be, why aren't they know the value's there. Why aren't they going out and buying back shares? Why? I know they do acquisitions, but they've got plenty of liquidity. They could do both if they want. Why aren't they taking advantage of the multiple?
Yeah, I mean, I think this is, as with a lot of family companies, this is a very conservative finance business. I mean, it's just slightly over 1 times geared. Historically, it's going to maintain that type of gearing. I suppose, this is, I mean, why aren't they buying back shares? I mean, this is effectively like it's almost like a privately held business that happens to have a legacy public listing. So, they don't have any analyst coverage. They don't hold investor days. So, they're not really, they're not really minded to kind of, drive value through buybacks or other kind of financial engineering. They're kind of content just to operate the business and continue to grow it. And one of the things I suppose in terms of capital allocation is that they have invested on a relative basis. They've invested more in growth capex than their peers. So and a lot of that is through bolt-on acquisitions, particularly on the home care, residential care side of the business, where they've bolted on smaller operators, and then there's a kind of a multiple arbitrage there, where they're buying these smaller units or businesses at maybe 4 or 5 times EBITDA, bolting it in, and in a fair market, I suppose they're easily worth double that. So I think that's really been the focus in terms of capital allocation. They pay a decent, small dividend that has grown over time as well. But again, as I said, they've been content to kind of focus on operating the business without getting too, focused or distracted on kind of returning capital and levering up the business.
All right, so that covers the special situation side of the business. So, but there's another part of the business, right? Like, it would be great if we woke up 3 months from now, 3 years from now, 5 years from now, and the management said, hey, succession planning part of the business, we're selling this to private equity for 12 times EBITDA, 14 times EBITDA, and the shares would more than double, and we do great. But I think there's another thing where, hey, this is just a good business. We mentioned it's a Buffett-like business. It's done 15 to 20% IRR on the open market for well over a decade at least. So there's another side of this business where it doesn't sell, and you and I just wake up 3 years from now and we say, hey, EBITDA has grown, the business has done great, we've done really well here. So let's dive into the core business. The core business is the technical gas business, and then they've got the home care and some other stuff we'll talk about, but the technical gas business. I think if you've never looked at this and you and I said, oh, this is a Buffett-like business, you would say, gas, like they're literally just taking oxygen from the air. Like, why can't everybody go and do this? So can you just dive into like, what is the core technical business, and why is this such a good business that we said it's a Buffett-like business?
Yeah. Okay. Yeah. So I mean, the key attraction of this business really is that it takes what it produces, gases such as nitrogen, oxygen, argon, helium, and so on. These are essential commodities for most manufacturing and industrial processes. So this business has a pretty high barrier to entry in terms of it's capital intensive to get up and running. It uses a lot of heavy plant equipment such as air separation units and so on. So it takes atmospheric gases, it breaks them down into the component gases such as oxygen and so on, and then it distributes these or supplies these gases to industrial and manufacturing customers in a number of different ways, and these are all subject to long-term contracts. So what makes this a great business, and is that they're so tied into their customers' operations. So, for example, some customers will they'll have a pipeline directly into that customer's production facilities, and so that the switching cost to that type of delivery is so high that they just that revenue stream is nailed on.
It's literally the best switching cost, right? Like the only way you could switch, because as you said, it's a pipeline from the plant directly to your customer. Like, the only way you could switch is, I guess, you could start hiring trucks to bring in like canned gases, but that's so expensive. And that's why like any pipeline business, many of them, I don't believe any pipelines here are regulated, right? But many people do, like oil and gas pipelines get regulated because once you build it, it's a legitimate monopoly, right? There's no other way. And you can just start taking all these excess profits. So that's why it's so great. Let me ask 2 questions on the gas business. So the first question, right? Like, I did some write-ups and some work on Party City, and I actually have been meaning to finish those write-ups. But like, Party City basically gets helium from people, and they distribute helium in stores. And Russia invading Ukraine, it turned out a lot of helium came from Russia/Ukraine, and now there's this helium shortage that's going around. And I know a lot of gases, like you say, oxygen, and we're not going to be short of oxygen, but a lot of gases actually we have had shortage issues with. So are they having any issues with kind of the supply of the base gas and everything coming into them? Have they run into any of that?
No, I mean, in the case of helium, that's quite a niche gas, and while Sol do provide it, it's not one of their main gases. I mean, there are 4 main gases, which are about 60% of their production, are oxygen, nitrogen, carbon dioxide, and argon. So they're in terms of kind of being able to continue to supply, they don't really have any issues there. So they're kind of insulated from some of that risk.
And then second question I had, so you mentioned when we were first starting, you said, hey, these contracts are CPI inflation linked, which is great. Everybody, it's not going to be a surprise to anyone who's listening to this podcast that inflation is running high. But I was concerned, like, look, a big piece of this is you take the base gas, you put it through whatever they do, and it takes energy costs. And anybody who's familiar with, these are Europe, most of their business in Europe, and energy is mainly coming from natural gas and nat gas. I'm just looking at my screen, you know, I think it's TTF Dutch gas. It's gone from 55 last year to, as you and I are speaking, it's about 132, right? So
Yeah.
it's almost tripled, and inflation has not tripled. So one of my concerns, and I think it was either your write-up or the annual report where they said, hey, the cost for us to process gas, it used to be, the energy costs were like, used to be 50% of our revenue, and right now they're running about 90%. I think it was your report. It could have been annual.
Yeah.
I was concerned, like, yes, they're CPI linked, but their cost piece is running so much higher than CPI. Like, are they going to run into issues? Does that make sense?
Yeah, so I mean, that was one of the questions I'd put to management when I spoke with them. And I think, yeah, so historically, pre kind of the current, energy crisis, the energy and electricity costs are about 60% of their total cost base. That's about 90% now because of just the, what's happened with inflation. And so, yeah, that's the obvious risk to this in terms of earning power. But again, coming back to the fact that these are essential gases, there's no substitute. And the customers are tied into contracts, so they have an ability to pass on these costs, and so that's what they've been doing, and that's what I expect to see, kind of in the second half of this year. They don't report. A lot of these companies like this in Europe don't report quarterly. It's kind of interim, half year and full year. So, I would expect kind of towards the end of the summer when the half year report comes out that you will see. I mean, I'm not saying they're going to be immune from it. There will be a lag, of course, but they have CPI linkage in their contracts, so they are able to pass that cost on, and customers generally will have to just have to eat that cost increase if they need to continue. I mean, if you're operating a steel blast furnace, you need oxygen and other gases to operate that. If you don't have oxygen, you can't operate, and you're idled. So that's the essential, I suppose, point coming into play there.
Come dive into conspiracy corner with me for a second here, right? So right now, let's just use round numbers. Nat gas in Europe is 100, right? And this is up from 50 last year. And if you go back pre-COVID, 2019, it was like 10 or 15, right? And I do wonder if they strike a lot of contracts right now, and they base them on, hey, nat gas is 100, 150, 75, whatever it is. Let's say we fast forward 3 years and nat gas has gotten under control, right? In the US, nat gas is still 6 and it's 130 in Europe. And that's going to take a long time to normalize because similar to pipelines, like we've got to build all these LNG facilities and get them over there. But at some point, I would guess nat gas comes down from 130 just because it's so high on an energy basis. Like if nat gas is 20, in 4 years, I wonder if they're going to have a bunch of contracts that were struck when nat gas was 100, where their energy costs have come so far down that they're actually super profitable because they're CPI linked to the upside. I don't think they're going to be like kind of on the downside with those energy costs. Does that make sense?
Yeah, no, I mean that is a valid point. I think yes, the whole purpose of the CPI linking is to protect them when costs rise. And they're able to push through those cost increases. When costs turn the other way, there's, I suppose, less. They're able to, while they may over time, if costs really drop dramatically, customers are obviously going to look to kind of look for some relief on that. But they are going to be able to capture some excess profit in that type of scenario. Because I suppose just with inflation now being a more possibly structurally higher for longer type dynamic, I think that they will be able to kind of keep some of that cost increase.
What kills this business? So it's, again, industrial gases used in hospitals, used in industrial processes. Like there's not a lot of, obviously the first thing that comes to mind is oxygen when a patient is going under. Like there's not really a replacement for oxygen. Is there any long-term obsolescence risk here? I've just been thinking a lot about like what kills a business, because for years, if I can go on a tangent, for years everybody has said what kills Google, what kills Facebook, all this type of stuff. And it's hard to imagine, but like I saw something where TikTok, a growing share of searches are on TikTok. Like TikTok could actually kill Facebook. I don't think it kills Google, but it could actually kill Facebook. And TikTok actually could kill legacy media because the competition for time is going up so much between video games, TikTok, and all this sort of stuff. Like there's just less time in the day to turn on HBO or watch Netflix. And this isn't all that's driving Netflix's stock price, but you can see some of that in the media company stock price. So with these guys, I've just kind of been thinking like, over time, what kills them? Is there any obsolescence risk to, obviously not oxygen, but just the products in general? Or what do you really worry about at night with this investment?
In terms of obsolescence risk, I mean, I don't really see much of a risk on that in terms of the. I mean, if you're talking about kind of their facilities and their production, capability. I mean, they invest a pretty healthy amount in R&D and in growth, and also in terms of their maintenance capex. So it's a very well invested business, and so from that point of view, in terms of equipment and so on, I think they're pretty well positioned. In terms of obsolescence, in terms of the end products, I mean, it's hard to see. I mean, as you said, there are things like oxygen. I mean, for medical end uses, I mean, that there is no, that there literally is no replacement for that, for, oxygen treatment and respiratory therapy and so on. And also, I think in a lot of the production processes, they're pretty well, they're a pretty core part of those processes. I mean, I think if I was to really think about, what could change in terms of maybe something like ESG in terms of how steel is produced. I mean, steel production is one of the most heavily pollutant industries out there, and there is a push in terms of how blast furnaces are operated and how to make them more carbon, to decarbonize that process. But then again, the flip side of that is that carbon capture is a growing, is a growth opportunity for a business like this. I mean, Air Liquide and Lind are very focused on that, and so I mean that's an area that Sol can grow into as well in terms of capturing carbon, regasifying it, and then using it then for other end uses.
How do you, again, I do work for this podcast, but I didn't dive into the comps fully and everything. How do Air Products, or how does an industrial gas player play into carbon capture?
So in terms of, they would typically, say a customer which emits a lot of carbon dioxide in its manufacturing process. So, Sol or Air Liquide or someone can come in, capture that carbon dioxide that's emitted, and effectively recycle it, and then use it for, carbon dioxide is used in carbonating drinks, food and beverage. It has is so many end uses.
I drank a whole soda water during the podcast. Anyone on the YouTube can see I'm holding up an empty soda stream thing. So I'm very familiar with how carbonated water.
Yeah, I mean, that's just one very simple everyday use. So I mean, carbon dioxide is used in a huge, in a vast amount of, industrial and manufacturing processes. So I mean, that's one way in which they can, that they can maybe use that carbon capture as an opportunity to grow.
I understand why they would be the person to process the carbon, right? Like you're going to bring the carbon dioxide to their facility, they're going to bottle it, process it, get it compacted, whatever it is. But why would they be the person to capture it versus, I honestly don't know a lot about the carbon, but it does seem like going to the actual customer site and doing the carbon capture. Why is that? Why should they own that versus, I don't know who the competitor would be, to be honest, but it seems like that's a completely different skill set.
Well, no, because I mean, it's part of, I mean, maybe talking about competitors, I mean, the likes of Air Liquide and Lind are obviously going to have focused big time on that, on carbon capture. And so, any of the really large industrial plants and facilities, they're obviously best placed given their scale and given the relationships with a lot of the larger customers to do that. But I mean, Sol as a pretty decent sized regional player with a very diverse, customer base, would equally be well positioned to service that segment of the market.
Yep. And you mentioned they do a lot of growth capex. They do a lot of bolt-on acquisitions. And, when you talk risk, there is the risk that if they're doing lots of bolt-on acquisitions, that some of them fail or sell, but they're doing, again, it's bolt-on, not transformative. So even if some of them fail, it's like, okay, we lost 3 months of profit, 6 months of profit. It's not we levered up to 5x and like bankrupted the firm on them. But you also mentioned they do a lot of R&D, and there was this, I'm trying to find in their slides, there was line how much they spend on R&D. But I was just curious, what do you spend on research and development for industrial gases? Is it new uses for industrial gases? Is it just generally improving your kind of method of production, or what are they spending? Because it seems like that's a business that's been around for 100 years. There's like not a lot to research, if that makes sense.
Yeah, well, I suppose there's constant kind of need for, in terms of science and laboratories, universities, where there's new processes, new applications, and so a lot of the R&D spent is around trying to serve those new evolving kind of requirements. And also kind of diversifying into kind of other areas or other customers. I mean, biotechnology is one field now that they're looking to, leveraging off their experience in the medical space to date, and kind of, expanding into that field. So in implementing that type of expansion, there's a certain amount of R&D involved in that as well. So that's just kind of one example maybe of where they're, of how they're, spending R&D.
Perfect. So look, we've now covered the industrial gas side, and I want to, anything else we should be talking about gases, or I do kind of want to turn over to the home care business if that works for you.
Yeah, no, that sounds good. Yeah, I think we've kind of covered all the key points on the industrial side.
Perfect. So they've been growing into the home care business, and actually it's been, I think this was a little surprise to me, better returns on capital in the home care business. I think it's almost 50% of the business at this point. So I just wanted to, what is the home care business? Why'd they get into it? Why are there better returns on capital here?
Yeah, so home care is kind of more like a service business rather than a production business. So I think around 1986, in the mid 80s, they made the decision to diversify into kind of the medical and healthcare sector, leveraging off kind of their ability to produce oxygen and other kind of gases that are key to, in the medical field. And so one way they did that was to set up this service business, which is they call the home care segment. So that really involves, calling to people and their patients in their home setting or in residential care facilities, typically outside the hospital setting, and administering oxygen or other respiratory or other kind of services, and that includes provision of equipment, ventilators, replacing gas canisters and so on. And so it's really a service business, and so in that sense, that's how it's kind of it's capital light, in that it's not they're not kind of spending huge amounts of capex on equipment and so on. And it's also higher margin then as well. And I think the margins are kind of close to 30% EBITDA margins on that side of the business. So it's kind of it's asset light, and it's service focused. And so particularly it's kind of really boomed over the last 2 years with COVID, and obviously that was a huge tailwind for the business. And off the back of that, that's continued to grow. I mean, in terms of pathogens and respiratory illnesses are becoming more and more frequent, and so that's again a kind of a growth area, a continued growth area for the business that they're particularly well positioned in.
Perfect. Now, so most of their businesses in Europe, and they do have a expanding South American, I think Brazil, they've got some in China, so emerging markets on the home care side. But, I'm US domestic based, and I think for any US domestic listener, when you hear home care business, they've got oxygen therapy, ventilation, telemedicine. When you hear all that, you've got really bad dreams of the home care businesses in the US, which tend to be, they grow quickly, they've got great margins, and then in the US, Medicare pays for most of them. Medicare does a huge cost cut because they say, oh, look, there's a cute little home care business that's getting 25% EBITDA margins in this sector. 25% EBITDA margin is too high in healthcare. We're going to cut their reimbursement rates by 30%, and the business goes from growing and profitable to really flat. This business has grown. I'm looking at their slide for people following along. It's slide 34 in their full year 2021 presentation. It's grown really nice. 9% annual growth for over 10 years, almost 30% EBITDA margins. Like, this is a good business. But just for my domestic listeners who hear home care, good growth, great margins, why is this not a business that's like kind of on the chopping block for competition, margin depression, all that type of stuff?
Yeah, well, I suppose there's only a handful of operators. There is limited competition in the space. There's only a handful of operators, and I suppose the need, with aging demographics in Europe, and particularly now post-COVID, and with kind of increased focus on respiratory illnesses and treatment, there's only a handful of kind of companies that can really deliver at scale. And these guys are tied into either the insurance companies, the health insurers, or national health services, depending on the jurisdiction, whether it's Italy or Germany or wherever they're providing the service. So, it's the reliability of the service and the ability to kind of, serve the market that, they've, I mean, in theory, yes, it's a risk. In reality, is that going to happen where they're going to be, where the economics are just going to be cut down on them? I think it's unlikely, just given the relationships they have in the market with customers, and kind of, the level of service, the quality of the service they're able to provide.
Perfect. So home care versus, again, home care actually starting to become it is a really meaningful part of the business, right? I'm trying to do the EBITDA comparison as we speak, but is there a multiple difference? Like when we started, we were just saying, hey, this business trades 7 times EBITDA. Is there kind of a multiple difference in, if we just sold this business SOTP or whatever, between the Airgas side and the home care side?
Yeah, I mean, when you look at the competitors and look at the other players in the market, they all, I mean, Air Liquide, Lind do provide kind of similar healthcare, services, or home care services as well. A much smaller part of their businesses in relative terms. So, there isn't a pure play, to break out the multiple. There isn't a pure play trying to see where the market benchmarks, home care versus industrial gas. So all the comps are a kind of it's a composite multiple, although probably, more skewed to the industrial side in terms of overall revenue mix. But then again, I mean, if those comps are trading at 12 to 14 times, and they have, say, 20% of the business or less is home care, and 50% of Sol's is home care, and that's a higher margin, less capital intensive business. I mean, that's even more supportive of a higher multiple for Sol.
Yep. And actually, I was just looking at the sides. When I do it, and I'm sure the company thinks this way, because the first thing they always present is the technical gas side. That's what they're known for. That's what they talk about. At this point, I think the home care business actually does significantly more in EBITDA than the technical gas side. It's 160 in EBITDA from the home care side versus, I think it was 90 in 2021 from the technical gas side. So we talked about gas the whole time, and you actually might say, oh, this is more home care business, though home care does get some stuff from technical gases. So yeah. Anything else on the home care business, or I want to talk about the 2 emerging lines as well?
No, I think that's it. I mean, I suppose one other point just on the multiple actually is just, if you look at other kind of similar healthcare focused businesses, you see a lot of it's been a kind of a typical private equity play in Europe over the last number of years, whether it's healthcare, doctor services, veterinary clinics, and so on. That roll-up model where they buy and build platforms, and in the private markets, again, those businesses can trade, for 15 times, 16, 17 times EBITDA. So again, just looking at that as a kind of a broader comparable. Again, that's kind of supportive of a higher multiple for the Sol's home care business.
And they've got 2 startup businesses. They don't devote a ton of slides to them, but one of them is the biotech business, and one of them is the hydro energy business. I've got a few questions on the hydro energy side, but just anything you want to say on the biotech side of the business?
Yeah, so they're both more recent kind of segments that they're developing. They don't break out performance for those smaller segments because they're very, very small. I mean, biotech is really an offshoot of the existing medical and home care business, and really that's a very new business. So I mean, that will take time for that to become a meaningful part of the business. And then the other piece, the hydro business, is that's very small. I think it's really they own some hydro energy plants, but I don't think that, I mean, that they partly serve or power their own operations rather than being kind of a whole new service segment.
No, just on the hydro side, I thought it was really interesting. And again, I don't know how much these are hydro plants. I believe it's 6 hydro plants owned and operated in Eastern Europe. But as we talked about earlier with nat gas, like this is a business that is structurally short electricity because this is a very energy intensive business on the gas side. And I was just thinking, oh, how clever to have hydroelectrics. And I was also wondering, could there be like a little bit of hidden value there? Because as we've talked about, nat gas prices are through the roof. Electricity, there's an electricity slash energy shortage crisis, whatever you want to call it, in Europe currently, and it doesn't look like it's getting any better. Owning six hydroelectric businesses, like hydroelectric's base load, the marginal cost is basically zero to produce. Like that's probably not too bad to have right now.
No, it certainly makes sense, and as I said, they do use it to power their own operations in some of their locations. But it's such a small part of the business that it's not really material to the overall thesis. But I mean, in time, maybe it becomes something more valuable, and certainly it's a positive for the business in that they have that that maybe as a new platform that they can build on.
You never know, right? Because I just look at the slides and it says, hey, this is 120 million kilowatts per kilowatt hour per year of hydroelectric capacity. And I don't know how much 120 million kilowatts hour per year is, right? Like you could tell me, oh, their businesses take 10 and the other 110 was like making nothing, but it turns out at these electricity prices, it's going to be like just mini money out the roof. Or you could just say, oh no, it's just not enough. I had no idea. So I was just wondering if there was something hidden there. Look, I think we've done a pretty good job covering everything here. Anything else you want to talk about on this on Sol, or kind of finished up here?
Yeah, I think just in terms of, you touched on it earlier in terms of the downside, or I mean, I'm looking at this as a kind of a special situation in that the takeout is real the driver, or the kind of catalyst number one, if you want to call it. And that aside, a market re-rating, just given the quality of the business, it has no sell side coverage. If they decide to kind of maybe start engaging more with analysts, investor community, that could drive a market re-rating. And I would expect a business like this to re-rate pretty quickly, just given the obvious quality of it. But that aside, that's one of the really appealing things about this as a stock, is if it just continues as is and just grows in line with its historic trend, the kind of forward prospective rate of return that you can expect to earn on this is kind of 15 to 20% without any multiple expansion. That's just through continued earnings growth in line with trend, not doing anything different to what they've done for decades. But there are, that being said, there are growth drivers in terms of decarbonization, carbon capture, and other, there are other growth opportunities there. But let's assume that they just keep doing what they're doing, no multiple expansion, and you get the 1.5% dividend, modest enough dividend. I mean, that breaks back to a kind of over the next 5 years, a kind of a 15-20% return. So I mean, if that's your downside, I mean, that's downside. I say downside.
Yeah, your downside is one of the best investing records of all time, like 15 to 20%. It just
I say downside in the context of the kind of the special sit thesis not playing out. So I think it's kind of it's kind of hard to see any real downside to owning this. I mean, you can expect a decent, very acceptable rate of return at a bare minimum, and you get the free option of market re-rating, plus potentially the liquidity event where it's a 2 to 3x in 5 years' time.
Yeah, look, I think the downside would be everyone's looked at family controlled companies before that trade for obviously less than they would go for to sellers, to motivated buyers who would like kind of financially maximize it. But here the nice thing is, you're paying a cheap price, and it's a management, again, like 15 years, really good returns. They grow the business, these things. I mean, this is literally just both of their core business are literally just steady up into the right, revenue, earnings, all that sort of stuff. And part of that's driven by inorganic growth. But there's not a huge difference between inorganic growth if you're taking your cash flows and buying like small bolt-on businesses for 4 or 5 times EBITDA and just going and doing it yourself. Like, it's not a huge difference if you can do it consistently. So like, to me, a lot of people would say the downside is family doesn't care. They're just not going to do anything. It's like, okay, cool. Then they'll do what they did for the past 15 years, and shareholders past 15 years, past 100 years, and shareholders will still be pretty happy there. Let me switch it up a little bit. We've been going almost an hour, but not quite an hour. So I'll hold you to the hour timeline. Look, you do this great weekly bulletin every week where you dive into, hey, here's some interesting event ideas. You've got the AOB, any other business, where you just talk about something interesting. So we're talking on, what is today's date? It's June 28th. We're talking June 28th. So you'll have another one coming out like Friday or something. But just wondering, what's on your mind these days in the markets?
Yeah, I mean, I think, there's a lot of concern around, a lot of increasing talk around recession risk, and are we looking at a recession now, or is it a stagflationary recession? One of the areas of the market that I think is interesting, and I kind of just in that kind of more, and I'm not a macro investor, but I like to kind of look at some of the kind of more macro indicators at times, just to kind of get a feel for where just to try and frame, I suppose, where the market's at and how I should be thinking of it. And I think I think the high yield space at the moment is, there are signs of potentially high yield cracking, leverage loans and high yield debt. I mean, that's collectively about over $3.5 trillion worth of debt outstanding. 90% of leverage loans now at the moment are covenant light. So there are no warning triggers now, and we're looking at we're just talking there about cost inflation and energy input cost increases. You're looking at wage inflation is going up, costs are going up, interest rates are going up, so debt service obligations are going to go up, and you've got a lot of highly levered companies out there that are approaching that potential pinch point. And I know anecdotally already that there's liquidity is drying up in leverage loans and in the high yield space. You've got a whole $3.5 trillion worth of triple B. That a healthy chunk of that, you've got to think it could be lined up for a downgrade, which would lead to forced or mandated selling by a lot of the holders, which is going to impact spreads and credit risk perception again as well. So I think that's just interesting. I mean, how does that inform my view of equities? Because I'm an equity investor, equity analyst. So I'm kind of interested in parts of the market that are, maybe insulated from some of that wider credit risk and kind of some of the macro risk, and where I think some of that you can find some of that insulation is in special situations and in certain kind of commodity related names.
It's funny you say you can find that insulation in special situation, but I will tell you my special situation book that was put on in March would tell you that you do not find that insulation in the special situations book, because, it's just interesting. Like, special situation should be market neutral, but if it is a, Soul would be different. But if it is a company that has been rumored to be up for sale and you look at it and you say, oh, this company is trading for 8, comps go for 12, I'm going to buy it because it's rumored to be put up for sale. I think it's good. I think they'll get a huge premium. Like, when the market falls apart, spreads blow out, like the stock sells off really hard because people quickly start looking at it saying there's no way they can finance this deal. Now, the flip side to that would be, if you're looking at something that's doing that right now, it could be really, really interesting, right? But I'm mainly laughing at myself because I don't want to cry on a podcast, if that makes sense.
Yeah, no, well, I mean, you're right. I mean, in times of stress, correlation is one, and if there's a liquidation event, there's a liquidation event. And everything sells off, and you just got to be ready for that to take advantage of it. I mean, that March 20 was a brilliant time. April 20 was a brilliant time to kind of pick up some bargains. So, I think the way I'm thinking about things now is maybe preparing for a potential sell off. And I mean, I think there are other situations there at the moment that I think you can where they can offer good risk adjusted returns independent of maybe what the market is doing. I mean, I think you look at what Buffett is doing recently. I mean, the two biggest the two most interesting two of the biggest bets coming out of the recent Berkshire AGM was the Activision merger arb play and his bets on energy. So I mean, that their commodity and special sits. That's what Buffett is doing in the absence of everything, in the absence of any other opportunities. So I mean, to me, I think that's a very interesting tell.
Commodities are interesting because I think I've written about this, talks about it tangentially on the podcast and stuff. But I just keep looking at all these commodity companies, and Buffett's buying Oxy, and I think Chevron he's buying that too. But
yeah,
if you just look at those, and you can apply this to a host of commodity companies, literally almost any energy and gas company. The spot price for domestic US is $100 oil, $6 nat gas, let's call it. Next year, it's $90 oil, $5.50 or $5 nat gas, whatever. If you actually DCF all these companies out, they're basically implying the curve is $15 to $20 oil and $1 to $2 nat gas below where the curve is implying. So I think what Buffett is seeing, and I think what a lot of people are seeing is like, hey, the market is saying that the curve is flat out wrong in these prices. And if I buy them, like I get a lot of cash flow up front because they're getting super normal profits right now. So I'm basically betting on two things. The curve is close to right, and management's not going to light all this money on fire. And it seems like a good bet to me. Like a lot of these guys, Chesapeake is one I was looking at yesterday. I've done 30 minutes of work, so don't hold me to it. But like CHK, they literally went to a conference and they said at current curves, we're going to do $13.5 billion in cash flow to equity over the next 4 to 5 years. And their market cap is $12 billion, right? So it's like, hey, forget about terminal value. All the terminal value is free. We're going to get all this. And they say we're going to return the vast majority of its shareholders. Anyway, I'm rambling a little bit. I want to give you last thoughts. Anything else on Sol? Anything on the energy rant I just went on? Anything else you want to talk about?
No, I think you're right. I mean, I also think kind of certain niche commodities. I know you had a podcast recently on Alphamin, and that's a name I've written.
I know you have. Yep.
Written about as well. And I think that's a really good example of that's a company in play. It's a strategic metal. It's very niche. And I think that's another type of situation that I think is interesting in the current market, and that you've got a secular tailwind behind it, but it's also a special situation in the near term that kind of mitigates some of the other risks that might be there in the near term.
Yeah, it does. Until, of course, I record the podcast, and 5 days after I record the podcast, TIN's down 25% to the lowest it's been in like 18 months or something. But I still think that's interesting because, as Brian mentioned on that podcast, even with TIN, it's at 27,000 right now. Like the share price probably implies something lower, and these guys are structurally advantaged in TIN. But anyway, Conor, You've gone for an hour. It's been great having you. Time number 2. Looking forward to time number 3. I'll just pitch you again. Look, I was a literal moment one, number 1 subscriber to Conor's thing. If you are looking for value, special situations with especially a European flair, I'd say there's some American stuff, but especially European flair. I think you do fantastic work. I think it's fantastic stuff, and it's well worth checking out. So I'll include a link in the show notes if everyone wants to check it out. But Conor Maguire, thanks so much for coming on, and looking forward to podcast number 3.
It's great. Thanks, Andrew.